This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 349 was produced on November 10th, 2022. I'm Eric Townsend. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. We've got an extra long show for you this week, but it'll be a good one for you crude oil fans. Commodity Context founder Rory Johnston will join me as this week's feature interview guest. Rory is a veteran crude oil market analyst and first-time MacroVoices guest. We'll do a deep dive on crude oil supply and demand fundamentals, China reopening, Russian sanctions, and finally, the long-awaited Strategic Petroleum Reserve Discourse, we won't call it a debate, that so many of you have requested. I intentionally let this interview run long, almost 80 minutes as compared to our usual target of 45 to 50 minutes, but I think you'll find the content well worth your time.
And I'm Patrick Ceresna. Listeners, be sure to stay tuned for our post-game segment after Eric's feature interview with Rory Johnston, when Eric, Nick, and I will discuss the market's reactions to the elections and inflation numbers. We'll also look at the charts on the S&P 500, the VIX, the US dollar. We'll also touch on those charts on crude oil, gold, copper, and that 10-year treasury yield. Now, Eric, before we move to the feature interview with Rory, let's cover the EIA crude inventory data.
Well, this week's show is all about crude oil, so I'm just going to cover inventory and what's happened in the market since the feature interview was recorded Tuesday afternoon. I'll leave the rest for the feature interview with Rory Johnston. EIA inventory printed a great big build of 3.9 million barrels of crude oil, but what really happened was a build of less than 400,000 barrels, plus 3.6 million barrels that came out of the SPR. Cushing, Oklahoma drawing down 923,000 barrels, gasoline drawing down 899,000 barrels, distillates drawing down 521,000 barrels. So drawdowns on finished products build on crude oil inventory. U.S. production ticked back up 200,000 barrels per day to 12.1 million barrels per day. The tape action on inventory, there was already a great big sell-off underway, and that continued or perhaps even accelerated after inventory data came out. Now, on Tuesday, that was election day, and Wednesday, there was a pretty big smackdown in prices in crude oil. It's kind of curious that that happened on a big dollar down day as well. Normally, oil and the dollar are inversely correlated. I think what happened here is a combination of a classic buy the rumor, sell the news event on midterm elections. A lot of people thought that after the midterms, that would be bullish for crude oil because the government wouldn't be trying to hold gasoline prices down into the election. And I think what has happened here is that expectation resulted in a lot of buying ahead of midterms. Then as we actually got to election day, we had outbreak news coming from China when a lot of people were expecting more news about reopening of China's economy, and that really got the selling going in crude oil, essentially undoing the speculation that China reopening was going to occur. I do have a few more remarks on where I think the crude oil market is headed from here, but let's save them until after the feature interview with Rory Johnston.
This week's feature interview guest is Commodity Context founder Rory Johnston. Eric, why did we invite Rory as a first-time guest to MacroVoices this week?
Well, we've been looking for guests who disagree with my view that we're stuck in an energy trap preventing the global economy from getting back to pre-pandemic normal. I thought Rory was going to disagree with me pretty strongly on that one. Turns out that he didn't disagree as much as I thought, but he definitely disagrees with me on the Strategic Petroleum Reserve. So we're going to have a very interesting conversation. This interview did run quite long, but I think you'll find it well worthwhile.
Well, Eric's interview with Rory Johnston is coming up as MacroVoices continues right after this message from our sponsor.
If you invest to bring about a world powered by green energy, you should meet Respect Energy, a leading European trader of renewable energy that serves as a one-stop shop for green energy investors in Europe. Respect Energy brings together independent power producers, accredited and institutional investors holding assets in renewables, or undertaking investments in new green energy production, such as wind and solar photovoltaic power plants. More than 600 institutional and accredited investors have already entrusted Respect Energy with the sale of their electricity production, portfolio management, O&M services, EPC, and project development. If you want to invest in green energy in Europe with the help of a trusted partner, contact Respect Energy today and ask for a tailor-made solution. For more information, visit respect.energy.
And now, with this week's special guest, here's hedge fund manager Eric Townsend.
Joining me now is Rory Johnston, founder of CommodityContext.com. Rory has been an oil analyst in Canada for many years. Rory, it's great to have you on MacroVoices as a first-time guest. Thanks for joining us.
Thanks for having me, Eric.
I want to start by asking you to critique my thesis, or my bold call, if you will, which our regular listeners are already familiar with, which is I contend that the world is unable to return to pre-pandemic normal in terms of the overall global economy for the simple reason that we don't have enough energy supply. And my argument is it was proven actually in 2021, before there was any Russian invasion. If you look at the explosion of time spreads that happened in 2021, we had an incredibly tight physical market. And that was before any discussion of China coming back online. My contention is that once China does come back online, we're going to have more demand than we can ramp supply up to meet, and it's going to create a global energy crisis. Please tell me why I've got that wrong, because you know the physical market very, very well, and I'm dying to have somebody set me straight if I've got this wrong.
No, I will say I don't think you have the kind of broad contours wrong. I think that I share the view that over the next at least half decade, the supply-demand balance looks tremendously bullish for all the reasons that you mentioned. We're still decently below pre-pandemic production levels, and demand is there as well. And as you mentioned, with China one day eventually coming back to full production, we're still down somewhere in the ballpark of 2 million barrels a day, under where peak Chinese consumption was prior to the COVID-0 lockdowns. So I think that will definitely have a tremendously kind of price positive and bullish effect. I think the challenge is that we're still, I would contend, very new into this, latest regime of the oil market. If you can think about, the last regime kind of starting around 2014, when you had that massive buildup of shale production, growing at any price level, cratered prices, the new normal for, as far as anyone was looking forward, was in that kind of $40 to $60 shale band range. And that lasted, basically from 2014 right up until 2020. And I think a lot of people expected it to last longer. And a lot of the things that people said were inevitably kind of flawed or couldn't continue about shale really got punctuated and fast forwarded by the pandemic shock. But I think now a lot of the reasons that we're still talking about that U.S. shale can't produce faster, for instance, I think, as well, we're still in a relatively new period of, U.S. shale producers finding this cash flow positive kind of religion. And I think it's still too early to say if that's going to be a permanent feature. I think the other thing that's important here is that when people think about U.S. shale growing slowly, I think they think about it actually growing slowly, and it's still going to grow faster than any other producing jurisdiction on the planet. It's just probably going to grow at somewhere in the ballpark of half the speed that it was growing prior to the pandemic. And I think, just for context, in 2018, when Brent prices were around $60 a barrel for, on average for the year, U.S. shale or U.S. total liquids production growth grew by something like 2 million barrels a day, or more than the entirety of global demand during that period. That was an insurmountable wave of supply that the market could never work through in a way that you got 3-digit oil prices. But now it's going to grow more in the ballpark of, 500,000 to 1 million barrels a day, which I think is both a more sustainably kind of healthy pace of growth for the global oil market. But I think it's also still extraordinarily fast relative to what most other jurisdictions historically have ever seen. So I think that would be my point, is that I'm less certain whether or not this will be the permanent new normal, or if this is just another phase. And after a period of high prices and after some of these supply chain bottlenecks in the US begin to unwind, we can begin to see some of that appetite for growth at any cost again. I think it's, the oil market cyclical, psychology cyclical, and I'm not yet convinced that this is, the final end of history chapter of US shale.
Let's talk a little bit more about the global supply factors that I see as changing as a result of the pandemic in some cases, and before the pandemic in other cases. Nobody has ever been completely sure exactly how much spare capacity OPEC had. I would argue until very recently, when we found out by force that, they've just run out of spare capacity. And they haven't completely run out. Saudi Arabia, United Arab Emirates both appear to have some more spare capacity. Saudi has admitted publicly they have at most another 1 million barrels beyond what they're already producing. And they've said they have no ability ever to grow beyond that. They say 13 million is the absolute most they could ever do. A lot of people that I've talked to in the industry are skeptical that they could even do that. What I've heard is maybe in theory they could, really turn everything on to get it at that point, but maintenance requirements and so forth would prevent them from sustaining that. Meanwhile, the rest of OPEC is under-delivering against what they used to call their production quotas. Now they're calling them production targets, which I find very interesting. Just the change of terminology there is kind of telling to me. And the way I'm seeing this is, even before you consider any of the geopolitical conflict with Russia that's going on, before that happened, we were in a situation where the world had run out of spare capacity, with the one exception that U.S. shale was growing in leaps and bounds. It was recovering brilliantly from the pandemic, and my hat is off to everyone in the American shale patch who pulled that off. But at the same time, all of the analysis I've read, and I think what you just echoed a moment ago, is they've kind of done what they're able to do, and it's not likely that we're going to see 1 million barrels per day per year of growth going forward. So is there anything else on the global horizon that could be turned up in order to provide more supply that I don't know about?
I think you covered it pretty well there, and I think particularly your points about OPEC, I think, are well taken. I think we will likely get some more. The UAE has been very ambitious and kind of open with the fact that they want to grow production. They are consistently one of the only members within OPEC that doesn't seem to want to cut back production. They want to grow. This caused issues in the very early kind of months of OPEC's attempted rebalancing of the market. But I think you're generally right. And I think particularly it's going to be hard to fill the hole that a halving of U.S. oil production growth, and particularly kind of U.S. shale crude production growth, is going to be able to achieve. Beyond that, I think you really only have a couple other major jurisdictions that either have the appetite or kind of acceptable geology, at this stage at least, to see growth. And one of them, I'm actually writing a piece right now, and it'll be published shortly, on Guyana and this massive new offshore potential that ExxonMobil and its partners have found in deep water offshore Guyanese territory. And I think that's going to be an example of something that we've seen is really, really interesting and different from what I think many people would have expected, prior to the pandemic. And these fields are massive. It's probably one of the most successful offshore exploration experiences in history, arguably. And many of those projects were developed and kind of scoped at the bottom of the price cycle. So a lot of these projects are building in, $25 to $35 Brent break-evens with, top of the, absolutely top of the line technology, and all of this utilizing these FPSOs, or these floating production, storage, and offloading vessels, with these tie downs on the bottom of the ocean floor. I think that is going to be what we're going to see more and more and more of as I think the next stage of exploration kind of goes underway. And I think that's why I'm less confident that I know exactly what it's going to look like, because a lot of this new technology is quite impressive. You're seeing similar deployment in the deep sea waters off of Brazil, as well as where I am in Canada. The Bay du Nord project recently received environmental approval from Ottawa, and it's going to be a similarly large, deep sea FPSO type production system off the coast of Newfoundland and Labrador. So I think those are kind of, those three countries I mentioned, Guyana, Brazil, and Canada, are going to be three of the major non-OPEC, non-US production sources. But I agree that beyond that, there doesn't seem to be a lot of readily accessible and attractive kind of exploration and production opportunities. You can always see that some of the production losses in OPEC countries like Nigeria and Angola could conceivably be reversed. It's just going to take the application of time, effort, and capital, which at this stage seems unlikely. But if we had a period of a couple years of three-digit oil prices, I think that calculation could change. And I think that's where the outlook for supply is always going to be dependent on those other factors. And that's why I'm less certain that it's going to be a hard stop constraint. But I do think that, to your point, it's going to require higher prices for longer in order to stimulate any kind of meaningful non-US shale supply growth. Because the market got used to effectively, I like to liken US shale growth with like that early stage of Uber and Uber Eats, where you had all of this capital destructive behavior that in the US shale patch case, incinerated upwards of $500 billion of investor capital in pursuit of what turned out to be ultimately uneconomic production. So I think that subsidy is gone, and I think what we look back at, and it seems obvious in hindsight, but there was never really a sustainable $40 to $60 shale band in the first place. It just realized that way because of the way that capital is deployed. I think that this next stage, I think, is going to be much more interesting, which is the U.S. shale patch is going to grow under the constraints of a currently kind of limited U.S. oilfield service sector, given the fact that it's not just exploration producers that have cut back capital and investment. It's also all of their suppliers and supply chains that have done so as well. In many cases, even more to the bone than the E&P sector did. So I think it's going to take a couple years, truly, of these higher prices to rev up that engine once again and rebuild capacity, both through the U.S. kind of OFS supply chain, but also through the rest of the world. And I think that does mean higher prices are required. Otherwise, I don't think we're going to get the supply. So I think in that way, I very much agree with your point there.
Tell me a little bit more about these three projects, starting with Guyana, in terms of the time to market. Let's say that we have $100 oil prices, so the market is there ready to buy this oil. In the next 2 to 3 years, how much of that could come online?
Yeah, so in Guyana's case, it's really interesting. So you've already, the first oil offshore Guyana was produced in December of 2019. So this is an extraordinarily new oil producing region. Since then, that was the Liza Phase 1 project. Liza Phase 2 actually started earlier this year in February. So we have the two Liza projects now operating with a nameplate capacity of about 360,000 barrels a day. Over the next couple of years, you're going to see incremental projects that have all been discovered, scoped, and essentially FID'd. They're going to come, increasingly kind of one a year almost. So you're probably going to get growth in Guyana somewhere in the ballpark of 200,000 barrels a day on average of annual gains over the next half decade. And just to put in perspective, which, it doesn't sound like a lot relative to the 1 million barrel a day swing we're talking in U.S. shale. Certainly nothing in history has ever been quite that impressive. But, to put in context, that 200,000 barrels a day of annual incremental growth is about the same pace that the Canadian oil sands saw in its heyday of growth between 2010 and 2015. So this is another, over the next half decade, Guyana is going to add 1 million barrels a day of production relative to the beginning of this year. And Guyana is going to go from a country that produces virtually no oil. There's less than 1 million people in Guyana. And you're going to go from essentially zero oil to the largest per capita producer on the planet. So not only are you going to have, it's going to be a major component of the supply story going forward, it's also going to be likely the most acute, accelerated resource curse experiment ever conducted in history. Because there's this big question of how are they going to operationalize and manage the governance around that very literal windfall. Rystad, a major oil consultancy, estimates that over the next kind of between now and 2040, the government take is going to be on the order of $150 billion US, which, this is a staggering amount of money for what was previously one of Latin America's most impoverished countries. So it's going to mean massive things for Guyana, but it's also going to mean kind of each and every year, if we're growing at, let's say, 1 million barrels, 1.2 million barrels a day, kind of supply growth, which is, I think, the optimistic kind of stable case, 20% or, roughly of that is going to be Guyana. So I think everyone is going to become very, very familiar with Guyana as an oil producing region. And that's exciting because it's new, and it's very rare that the oil industry actually runs into a completely new producing region. Even, the Permian Basin, it was a new rock, but I think everyone was familiar or a new way to utilize that rock. But everyone was extraordinarily familiar with the geology of the Permian and obviously oil and gas in Texas. Very, very different story, in Guyana. So I think that's going to be fascinating to watch.
Okay, but I just want to keep this in perspective, because if I heard you right, what you're telling me is optimistically the best we could hope for is over the next 5 years, Guyana might be able to produce enough oil to offset the US SPR releases stopping, which has been about 1 million barrels a day until recently. It's actually been throttled back a little bit in the last few weeks. But we're talking about the unsustainable release of US SPR oil has to end. I mean, at some point they'll run out if they don't end pretty quickly. They're supposedly ending that by the end of this year. It sounds like the growth in Guyana would take several years just to make up for that. Am I missing anything there?
No, that is correct. Now, I think now you add, let's say, 100,000 barrels a day of growth from Canada, or 150,000 barrels a day of additional growth from Brazil. And I think what you're going to see increasingly is a much more distributed kind of decomposition of that supply growth. In the decade prior to COVID, it was like 2/3 of every incremental barrel produced globally came from the U.S. shale patch. Again, just that's a crazy amount of oil. So I think for anyone that expects us to see a prolonged period of time like 2014 to 2020 again, where you had this wave, this kind of massive tsunami of U.S. shale crude that was constantly holding prices down, that I just don't see happening again. I think the only way, to your point, the only way you get an environment of lower prices that lasts for any period of time, in my mind now, is going to be because of something that's happening on the demand side. Maybe these Chinese COVID-0 lockdowns persist much longer than anyone expects. Or maybe we have some kind of next stage evolution or permutation of the COVID virus, or things that would reduce the demand side. I think still remain large risks to the outlook, given that at the beginning of this year, I don't think anyone expected China to hemorrhage 2 million barrels a day of crude demand either. That I think is the risk. But on supply, there doesn't seem to be any massive risk lurking around the corner that you could see U.S. shale supply growth explode into next year. I think what you'd need to see is it would need to come in stages, right? Because you have, I think, the two biggest factors right now holding back U.S. shale production growth, or U.S. oil production growth more broadly, is this kind of compounded factor of investor-imposed cash flow or an investment discipline. So this is just less growth, no more growth at all costs, profitable barrels only. In cases of producers like Pioneer, Sheffield has very clearly stated that, it doesn't matter if oil is at $300 a barrel, he's not growing more than 5% every year. I think that is a question whether or not that type of sentiment remains in the patch. But even once that begins to weaken, if it does, then you move on to the fact that there remains, extensive supply chain bottlenecks, from everything from frac sand to oil country tubular goods or steel pipe used in these projects has actually never come back down. At the beginning of COVID, or I guess partway through COVID, everyone was watching steel prices as this massive, COVID bottleneck that, put these prices to multiple times previous all-time highs, but then collapsed and came back down pretty quickly, mostly on, the erosion of confidence in China's real estate sector. But oil country tubular goods or the steel pipe never came back down. So not only do you have these, the steel price first, but then you had the fact that these, semis manufacturers were never able to catch up with the steel pipe demand. And then you lost additional steel pipe shipments from Russia and Ukraine. So that, I think, is another piece. And then finally, labor, which is this, other big factor of, for so long, you had seen people increasingly leave the oil patch during the downturns and never return. So even right now, I've seen some stats recently that like in Texas's oil and gas sector, you're at like 0.8% unemployment. But the overall employment rate in the sector has fallen markedly. So there's just less people in the sector. So we're going to need, again, a prolonged period of time of higher prices to pull people back into the sector, to pull capital back into the sector for all of these supply chains. And then the final supply chain, which I think could in many ways be the stickiest, is this idea of as mentioned, the OFS or oilfield service sector. You've seen a general erosion of capacity in pressure pumping, or the kind of final stage to complete these horizontally drilled wells. You need all this pressure pumping capacity. And that itself also kind of withered for a while through the downturn in 2014 to 2020. And then in 2020, I think many operators essentially just, threw up their hands and said, well, we're definitely not going to put more money into this now. So even when you had high oil prices and the OFS sector saying, maybe now I should start increasing investment. Oh, well, then all of the E&Ps essentially pulled a pioneer and said, oh, we're not going to grow under any condition. That's not a great sign for future demand for oilfield service kind of activity or just generally services. So I think it's going to be this multi-stage debottlenecking that's going to need to take place. And in all of those moments, you're going to need high prices, because at any point if prices collapse and one piece of that supply chain system kind of re-slackens, it just delays any of the capacity to unbottleneck.
Now, a lot of what you said is that the economic regime will be different in the 2014 through 2018 period, where there was so much easy money courtesy of what I think was reckless monetary policy, that it was so easy to finance these shale projects in the junk bond market. You could get money very easily to do just about anything. I agree with you. That's going to dry up. In fact, it's already dried up. It's not going to be so easy. But let's assume that after a year or two, if we get into the energy crisis that I think is coming, it's not going to be $100 a barrel oil anymore. It might be $150 or even higher. At that point, it becomes a national emergency, and perhaps under a different political leadership, the energy policy is different. And the government is saying, look, we're going to support our oil industry because we need to get out of this pickle. We're going to subsidize if we have to. So let's pretend that the sea of money is there again, because I think the sea of money will eventually come when we get to the point where we get a true energy crisis. And I do think that's coming. At that point, help me understand what's possible then in terms of shale growth, because my understanding of the whole 2014 to 2018 event is that it was largely based on what some people call either high grading or sweet spotting, where the idea is you pick the very best of the test holes that you drill, and you only actually produce the wells and complete the wells that are going to produce the most oil for the cheapest amount of money. As I understand it, most of those high grade sweet spots are all used up. And I don't know how many of the not so high grade, not so sweet spots are left, and I don't know how not so sweet they are. What if we did have a mountain of money available? Can you grow the U.S. shale patch up to 20 million barrels a day if you needed to, or is that geologically impossible?
20 million, I think, would probably be a heavy lift. But I do think that, and you're absolutely right, that we've seen this actually in multiple episodes through the U.S. shale patch, where you have these price downturns and people essentially jump back and you pull back activity, and essentially the rig weighted productivity of wells skyrockets because the only wells that are producing are the best things left. So I definitely do think that's true. But there is also this general trend line of productivity of companies kind of learning to do more with the technology and the kind of skills they have. So I think this whole learning by doing philosophy. So I think in all oil, but I think particularly in a kind of a system like U.S. shale, where in many cases it feels more manufacturing than it does kind of classical wildcatting. then it's, it really is. It's about process. It's about optimization. It's about, getting the right balance of paths and kind of working through all the issues that the sector had with kind of, child and orphan wells. And, there's just a tremendous amount of accelerated learning going on. So I do think that, will the geology, of course, will decline over time. But hopefully the goal here is that both the kind of skill set and familiarity with the geology will improve kind of all else productivity. But then as well, this windfall of money that kind of we're assuming this scenario would likely have to start on the oil field service side to rebuild all of that capacity back to a stage that you could actually complete these wells to a degree that you could get, million barrel a day plus crude production growth again. I think to me, it seems very unlikely that we will get that kind of world where you have, the 2018 kind of style of growth again. It seems unlikely that capital markets or equity investors would kind of, stomach it. But I also don't think that as we continue through the end of the decade, that is generally when people begin to assume that the demand begins to weaken. And I think with the challenge we've seen over the last, call it 3 years now, it's been really, really hard to get an underlying read on what the exit trend of COVID demand is going to be. Because every time you kind of think, oh, we're almost back to pre-COVID levels, as we were at essentially the beginning of this year, we were getting just back close to the kind of that pre-COVID high. Then China locked down again. So, it was the next stage of what the COVID shock looked like. So China was quite, it was essentially the demand savior in many cases of the world in, 2020 and into 2021. And then as the rest of the world kind of began crawling out of the COVID demand hole, then China decided to take its turn on the downside. And it was in many cases almost as dramatic as that initial COVID demand loss in 2020, but just happened to one country, albeit kind of always the largest incremental kind of demand growth engine. So I think there's this big open question of one, when does China reopen its economy in earnest? What does that look like? And do you have the kind of, voracious pace of growth that you had prior? I think these remain big questions. And frankly, I don't know. I think at this stage, no one really anticipated the scale or persistence of the COVID zero policy as we've seen it. The kind of classic refrain is that it doesn't make any sense, so it has to end, which I agree. It doesn't make any sense. It doesn't seem effective. It doesn't seem like it's politically sustainable, but it's also been going on now for 7-8 months, which is much, much longer than I initially expected it to last. One of the best comparisons I saw was the kind of drawing a parallel between COVID zero, particularly given the fact that the party has kind of tied its fortune to it so directly, and Xi Jinping specifically has kind of brought on this policy in a personalized way. And drawing a parallel between that and the one-child policy, where that was also something that was, everyone knew for a very, very long time that this was an unsustainable demographic policy, but it still took years and years and years for Beijing to eventually reverse that policy because of the politics of it, because they needed to essentially gradually change the narrative before the policy was eased. So that they had that cover. And I expect at this stage that we're going to see something similar with COVID zero. We could be starting to see the pivot of that narrative now. And as we were chatting about earlier, there's this optimism now, this week at least, or at least last week, there's this optimism about China opening. But I think it still remains to be seen, one, whether or not you get some kind of blowback given the high COVID cases in China right now. And then on the other side, if they're turning the boat, how long is it going to take to kind of fully do a 180 here? And I think we're probably talking more, again, charitably into kind of the first half of next year, maybe Q2, something like that. But I think there's just a big question of what that looks like on the other side.
Well, I completely agree with you that China reopening is the big catalyst that I think will be the event that brings on the energy crisis that I fear is coming. Let me just push back on a couple of things that you said, because I personally am starting to question some of the Western reporting on this, particularly around the language of COVID zero. Now, let's go back to the China reopening rumors that started 2 weeks or so ago. The rumor that came out was somebody who seemed to be very well connected and in the know said that they had heard that a committee had been formed to plan the reopening. It wasn't they're about to announce the reopening. It was a committee had been formed to plan the reopening, and that they were targeting March or so, and they named the guy who's very well connected in the Chinese Communist Party who was going to head up the committee. That to me still sounds like credible intel. It sounds to me like it makes perfect sense. China plans things well in advance. The fact that they're starting to plan how to do this, it all logically makes sense. And then Bloomberg over the weekend reported, well, the hopes have been dashed because China just announced that that's not really what's happening. They're committed to their COVID zero policies. And I thought, wait a minute. They didn't say, and I don't speak Mandarin, and I only speak enough Cantonese to order dim sum, so I don't know exactly what she really said. But I can't find anywhere in any of the reporting anybody quoting any Chinese officials saying we're not planning the reopening, or the rumors about the potential of a March economic reopening are false, or anything like that. All that they said is they're committed to their zero COVID policy. And when I think about the way governments announce things, of course they're going to say that. If they were ready to announce their reopening of the economy, I would expect them fully to say, we are completely committed to our zero COVID policy, which has been a great success. And furthermore, we've now reached the phase of that zero COVID policy where we're going to reopen our economy with cautious controls in place in order to protect the public health and so forth under COVID zero. So I think that the press is equating China's statement that they're committed to their COVID zero policy as refuting or disagreeing with the prediction that they're also planning the reopening. And I don't think those are incompatible things. Am I missing something?
I think part of the challenge here is that you've got the report, you've got the kind of policy on one side, you've got the reporting on another, and then you have the reaction to that reporting from there. And I think that, like you were saying, roughly 2 weeks ago, that initial kind of rumor that was circulating on Chinese social media that kind of started this latest wave, initially, when I first read it, it was reported as, this was a committee that was taking place. And then it was, again, it wasn't quoting exactly, but the tone was, this is this committee that's taking place right now, and they're exploring reopening now. And then it was kind of later, it was later revealed that, this is, it's kind of a plan for a plan later to do the planning to reopen. But I think right now, all this to me reveals, I don't think that we should be reading too much into either the reopening optimism or the reopen or the kind of reopening pessimism. I think that until we get to see, because I don't think it's going to be a subtle thing. I don't think that this is going to be something that various Chinese Communist Party whisperers are going to be kind of here or there, and these are the specifics. I think that using that same paradigm, that same framing as the one-child policy, you're going to have a concerted verbose shift of tone here. And I just don't expect that to be something that, even if they're talking about it right now, I don't think we're going to start hearing anything, at least until they're through this current wave that they're facing in China. Again, given that it's the worst the worst cases we've seen since the initial lockdowns began in April. And it would seem like to me like very strange timing to be pressing something kind of positive about reopening right now, but I also don't think that I don't think it's never going to happen. I just don't think we have enough information at this point to kind of say, is this a March thing? Is this a June thing? Which all mean very, very different things for oil balances, which is what we're talking about here. Whether that demand comes back in Q1 of next year means a very, very different thing that it comes in sometime in the second half of next year. And I'm, like we were saying earlier, kind of in this loose Q2 beginning to renormalize. But then again, I think it becomes the second question of, not only are they going to, we need to get 2 million barrels a day, roughly, give or take, back to pre-COVID or COVID era highs in China. And then there's the question of, well, what's their steady state of kind of growth coming out of that after that? Because before, you were seeing 400,000 barrels, 500,000 barrels a day of kind of annual growth. And if that also is slower, well, that does begin to help compensate for some of the structural loss of accelerative pace of U.S. shale.
Now, if I were China, if I were Xi Jinping, it would be very clear to me that I know the reopening, the full reopening of my own economy is likely going to bring on a global energy crisis. Therefore, what I would do to plan ahead for that is I would figure out how much time I've got between now and whatever the target reopening date is, and I would use that time to fill every possible nook and cranny of the Chinese SPR and build some more SPR if they have any capacity to do that in order to stockpile as much oil as humanly possible before the reopening, knowing that the price is going to go up when they do actually reopen and bring back all of that demand. We've already seen Goldman Sachs just this week published a research note saying essentially it appears that China has already begun to replenish its SPR by buying oil in advance of their reopening that Goldman thinks is already happening. What I don't know, and I'm hoping you can fill in the blanks here, is how much capacity does China have left? And it's not a published number, so we've got to go by guesstimates, but how much capacity could there be? If let's pretend that I'm right and China is going to use the time between now and March or whenever it is to refill every bit of SPR capacity they have, fill up the tanks to the rim with brim, so to speak. How many barrels is that, do you think, that they could consume just restocking before they reopen?
Yeah, like you said, it's always hard to get a good sense of exactly what China's SPR capacity is because it seems like they keep building new tanks. But I would say that, my assumption here would be, and we've already seen China kind of move through various phases this year of effectively building and drawing down their own inventories. And it's also muddied here because even the commercial inventory in China is kind of quasi-strategic and state-run, that even if the crude earlier this year wasn't going into the SPR, the China's SPR proper, it was still, Beijing directing these Chinese state-owned companies to buy crude in excess of refinery runs, which is what we were saying earlier. And, the latest numbers out now do seem to indicate that you are beginning to build crude inventories again because the crude, the total crude available in the economy is more than what they report they're running through the refinery. So that's kind of how we get these implied builds. And I expect, you could probably honestly have, 3-4 months here of, 1 million barrels a day or so, probably less on average, given that this is going to be a fairly volatile series. But I think that you could have, a decent amount of growth there. The way I generally do my balances, though, when I'm kind of building a global oil model, is the mostly focused on the refined products in China, less on the kind of availability of crude. And on the availability of refined products in the economy and the kind of output of Chinese refineries kind of and their net trade, that's the side that still seems down rather markedly, kind of in that 1.5 to 2 million barrels versus the kind of COVID era high. But to this, I need to do more work to kind of get a better sense of how much ultimately we could see go into China's SPR. But I wouldn't, nothing at the scale of where they dropped their demand out of this latest cycle.
Let's move on now to a couple of events on the horizon that pertain to Russia. Specifically, starting on December 5th, the European Union will embargo all imports of Russian oil. And then at some point after that, there's this discussion of a price cap that would be jointly under the guise of global oil guru Janet Yellen somehow imposed. Frankly, I think that one is so silly that I don't even pay attention to it, so I don't know what the timing is. But in terms of those two events, especially with respect to the December 5th European Union, a lot of analysts seem convinced it's going to take a whole bunch of Russian barrels off the market instantly. I don't agree, but how do you see it?
Yeah, so just to kind of scope the kind of various dates we have coming down the line. So you're right. On December 5th, there is going to be this implicit embargo. The EU is essentially banning all import of seaborne Russian crude oil. There are certain carve-outs for pipeline-connected refineries that essentially don't have any other choice. But seaborne is kind of this main focus here. So what's going by tanker? And the way the price cap comes into this is essentially, even if the EU has banned the import, there's this additional layer of the ban or the kind of what happens on December 5th is you also get this prohibition on Western, maritime service companies, the most notable of which, and the one people usually focus on, is insurance. You can't insure or kind of provide services to Russian tankers carrying Russian crude after December 5th. The way the price cap comes in is there will be exemptions to that ban on service provision if the crude for sale is under some as of yet decided cap. And the one thing I'll say here is I have publicly come out at the beginning of this saying that I don't think the price cap is a terrible idea, but I do think, and we're going to see parallels to this when we get to the SPR later, I do think it's a interesting theoretical argument that has been haphazardly and terribly executed. And the reason I think that is that I see this price cap discussion as essentially the next stage of secondary sanctions application. So when you looked at how Washington, sanctioned Iranian crude and Venezuelan crude, it was essentially no one can touch this stuff. And there was always this sort of Damocles essentially that, you couldn't be too aggressive on Iran during a period of, let's say, high oil prices like in late 2018, because there's this concern that it would kind of prompt, deleterious or politically, bad for the White House price spikes in oil. So the way that you could theoretically both have your cake and eat it too is that you could say, well, the crude could still flow, but it's going to be capped at a certain price. And the rationale for why any producer would accept that price is that the alternative would essentially be a full applications of secondary sanctions and them not getting any revenue at all and essentially losing and having to shut in that productive capacity. So in this scenario, if you had a price cap functionality for, let's say, Iranian barrels, you wouldn't have seen Iranian production collapse in the same way that led to some of the price increases. You would have seen it continue to flow just with less functional money going to Tehran. But I think where they dropped the ball on this is a couple places. One, on the marketing of it, I think the marketing and the political messaging around this should have always been around, this is an evolution of how we view sanctions policy, rather than what both Yellen and other, European leaders have said. And this is what really got, OPEC all worked up about it, is that this is the application of a, quote, buyer's cartel. And I think that's where this becomes super problematic, because I don't think that's the correct way of thinking about it. And furthermore, I think that it was always going to be really, really hard to enforce a policy like this, because it's already really hard to enforce a blanket ban on crude purchases like in Iran or Venezuela, let alone essentially needing an army of forensic accountants to come in and verify the exact contract terms, which, there are so many places for subterfuge and kind of deception here that, and the incentives to do so are literally, tens, if not hundreds of millions of dollars. There will be cheating. And the way we've set it up, or the way the policy has thus been framed, does not make it particularly easy to catch cheating. And I think one of the things that's been most frustrating to me is twofold. One, that from the get-go, Washington said that they would never consider applying secondary sanctions if the price cap was violated. There was always this perception that the Europeans wanted to go harder on Russia than Washington did. And that was because I think largely, DC is still concerned with price spike effects and kind of taking too much Russian crude off the market. So they've kind of been working at every turn to kind of weaken, I think, the effective, curtailment factor of Russian crude. So I think that's the one thing. So no secondary sanctions, no big stick at the other side. And the other thing is that the EU, because they don't want to reopen their sanctions package in the way that this has all kind of been negotiated over the prior year, what they should have said was European countries and companies can import Russian crude if it's below the cap, because it makes a lot of sense, because it's close, you have tanker access, you have established relationships, etc. But they said, no, because we've already decided that the embargo is going to be enforced, and now we're tacking the price cap theory on top of it, any chance you had at having a reasonably verifiable, close to your kind of area of interest, or area of comfort at least, that's essentially been dashed. So now it's going to be, European and American accountants trying to validate transactions between Russia and Saudi Arabia or Russia and India, which is going to be just an order of magnitude more difficult than the already insurmountable challenge of trying to do the same thing for shipments to, from Russia to Europe. So with that said, I think I have officially retired my support of the price cap, because I think, again, while it's an interesting theory, the execution is kind of where this is going to be made, and that execution has been very, very poor. To your question about how much are we going to lose, I agree. I think that there's more of a chance that we lose crude at this stage than we gain it. So, all else equal, it's still going to be a bullish event on December 5th from a fundamental perspective. But versus expectations, I think it's going to be a bit more of a wash. Part of why we saw such a massive flip in the market this year was we had, by my understanding, with the exception of maybe COVID, the largest pivot in expectations of balance impact in the oil market's history. In March of this year, we didn't think that China was going to lock down and hemorrhage 2 million barrels a day of demand. And we did think, and this was straight from the IEA, that by the end of the year, or even sooner after that, that Russian supply was going to fall by 3 million barrels a day. Instead, we lost 2 million barrels a day of Chinese demand, and we kept almost all of that Russian supply. So that, everything else equal, was a net 5 million barrel a day swing in expected global balances. I think that alone justifies the fact that we've seen, the levels of volatility we've seen this year. And I was saying to you at a different occasion that on some levels, it's actually a surprisingly little amount of volatility for how much call it the base case forecast, has shifted over that period.
It's interesting because I actually think that December 5th could be bearish oil prices for the reason that so many people have this expectation that a whole bunch of Russian crude is coming off the market. And I just don't see why that would occur. What seems very obvious to me is Russian crude can no longer be sold to the European Union. That means Saudi Arabia no longer has competition. They raise their prices to Europe. Europe has no choice but to pay them because it's sole source at that point. And Russia simply sells all of its oil to India and China, maybe at a slightly lower price than Europe is paying Saudi Arabia, but not a whole lot lower, and nothing really changes in terms of global supply and demand. What am I missing?
So I think the argument for why you'd see more of a demand loss. And I think some more of a supply loss.
And I forgot to add in there that I don't believe that any of this insurance and shipping nonsense is going to work. I think that China is quite capable of buying or leasing or coming up with their own insurance company or buying more tankers or doing whatever they need to do. If the opportunity is there for that Russian oil to go to China, they'll find a way to get it there.
I think that's probably right. But what I do think is that it's also a staggering volume of crude. It's going to be one of the largest logistical pivots in the oil market's history. And I think largest quote on history is going to be just a recurring theme here ever since the beginning of 2020. But the scale of this is massive. And it's, a tanker traveling from Baltic ports to a European country, you're measuring that journey in days, maybe a week round trip. The same trip to, of that same tanker from that port to India or China is months, right? It's, on a round trip basis. So the reason why the concern is there about the loss of supply is because the longer a tanker has to travel, the less effect. It's essentially I like to view it as almost like you're narrowing a pipeline. That same pipeline can carry a shorter distance than the same pipeline over a longer distance. So I think that's part of the concern there. Now, to your point, I do think that this, insurance and everything, there will be workarounds. And you've already seen massive shifts in the ownership structure of many super tankers. And this kind of the so-called shadow fleet is bulging. But that shadow fleet still needs to carry out Venezuelan shipments and Iranian shipments. So I think that's the concern is that there's going to be a logistical snafu here. And I think that's the most likely case. I think that if we do see an impact, we're going to see a relatively kind of sharp impact in December, maybe January, and which is similar to what we actually saw with the initial losses in March and April. The largest loss of Russian supply was in April. which is essentially after that first wave of self-sanctioning. Then it took a little while to reestablish which customers you were selling to, et cetera. I think that is likely going to happen here as well. The longer term story, and this kind of, again, goes back to this, global supply insufficiency narrative, is that even if Russia can maintain shipments in the near term, it's the longer term that becomes a question of how much can they support on the production side, absent all of the oilfield service company and, Western E&P, both capital and expertise applied to these fields. They were large factors in turning around Russian fields post fall of the Berlin Wall. And I think they've always been intimately related with Russian production. Now, you could see some help coming from, let's say, Iranian, petroleum reservoir engineers or Chinese. But I think no one is debating that the scale is not, and the kind of capability is not the same as if you had the full access to Western capital markets and Western OFS providers. So I think it's more of a long-term grind that I think is the kind of my, call it, oil price bullish view of Russia is, even if we have a sharp hit to supply after December 5th, I think it's likely to work itself out because, like you were saying, I think crude finds a way. You've already seen people discussing trying to rapidly build out pipeline infrastructure between Russia and Asia. I think this will always find a way to market. But I think the logistics and the kind of extra travel time create this kind of intertemporal pinch point that I think could be overinterpreted. And I think while it will likely be bullish immediately, I think the ultimate impact will likely wane in terms of its intensity.
Well, Rory, you haven't disagreed with me as much as I expected you to, but I have a solution to that problem. Let's move on to the Strategic Petroleum Reserve, where I'm sure we can find some disagreement. I think, though, it's really important to frame this and put it in context first, because really the reason that I disagree with you and Dr. Anas Al-Haji and a bunch of other very smart people in the oil industry is not that I actually dispute the substance of your arguments. It's because we have a very different philosophical belief about the purpose of the SPR, why it exists, what it's for, and so forth. If you were to presume that the purpose of the SPR includes managing gasoline prices for the sake of protecting the U.S. economy during times of geopolitical tension overseas, then the arguments that Anas Al-Haji has made, the arguments that you've made, I think are spot on. The reason that I'm in such strong disagreement is I don't think that's what it's for. I think it's entirely about national security and protecting the country against a situation where you get into a war where energy is withheld as a tactic of economic warfare, and frankly, I think that's coming. So I want to really focus on that aspect because you've done so much excellent writing and other interviews. Before we move on, just tell our listeners, for the perspective that you've already written about, which is assuming that the purpose of the SPR does include managing, gasoline prices and so forth, which I don't think is what it's for. Where's the best place, because we don't have time for it in this interview, where's the best place for people to come up on your views on that?
Yeah, so I have written extensively about my kind of views on the SPR on commoditycontext.com, so my Substack. Employ America and analysts there have also done a lot of really, really interesting work at trying to kind of reimagine the SPR and its application as an asset. And then I have also been on a couple other podcasts kind of talking about this, most notably Bloomberg's Odd Lots podcast, where I was on with my friend Skanda, talking about this and kind of how this policy could be used to help blunt or ameliorate some of the kind of worst impacts of the energy price spike this year.
Listeners, you'll find links in your Research Roundup email to find the writings and podcast interviews and so forth that Rory just mentioned. Let's move on now to my view of this is a little different than it seems like most people see it. I think the reason we need the SPR is so that if we get into a situation where a war results in energy access being cut off to the point where it's not a question of price, but Russia is unwilling to sell any of its oil to the West because they're trying to use withholding access to energy as a tactic of warfare. I'm not going to go quite as far as predicting that that is certain to happen, but I think that the risk of a conflict between United States and Russia escalating to that level is higher than it's ever been before. So the reason I think we need the SPR is because it seems to me that if Russia really wanted to get dirty, what they could do is, and frankly, I think they're already starting it. The first step is you play President Biden, get him to drain down the SPR as much as you possibly can in order to reduce the cushion that we have. And then at some point, when this war heats up, you say, look, we've already made a deal with China behind the scenes. We've also gotten friendly with Saudi Arabia after President Biden didn't exactly make the best of friends with Mohammed bin Salman. We've got a plan, and we're going to sell our oil to China and India, and it's not for sale to you guys at any price. Tough luck. If they were to do that, and if you really want to up the ante, if they were to infiltrate the U.S. green movement with FSB spies or, operatives or whatever you want to call them, and just fill some American greenies' heads up with the idea that the way to be a climate hero is to blow up the Keystone Pipeline. Not Keystone XL, the one that didn't get built because President Biden basically, as his first act in office, canceled it, but the existing Keystone Pipeline, which is the conduit that provides most of the import of desperately needed Canadian oil because it's heavier oil that can be used as blend stock in order to make the lighter U.S. shale oil refinable. If you were to blow up the Keystone Pipeline, or if you really want to get into this, if you were to blow up a couple of U.S. refineries and take out refining capacity, I think it would be fairly easy to persuade American green activists to do that. The FSB could provide them with some explosives and some training, teach them how to do it, and let Americans do the dirty work on behalf of Russia. I'm not predicting these things. I admit that I'm, thinking out of the box here in terms of risks, but I think this is a time where we need to be concerned about these kind of risks, and we need very much to focus on energy security. Draining down the Strategic Petroleum Reserve at a time, the first time really in 40 or 50 years or more than that there seems to be an imminent threat of direct military conflict between the United States and Russia seems insane to me. Do you just not see that as the purpose of the SPR, or why don't you and most other people in the industry seem to think about it that way? Am I missing something? Are the risks that I see not really there?
So I'm going to break this into a couple different pieces. And the first thing I'll say is that my views are I also believe relatively anathema to the majority of the sector. I think I'm a bit of a black sheep on this particular point. I think most people would say that the government shouldn't be interacting or trying to intervene to support the market right now. But I think the reason that I'd split it in two here is I think there's a theory of the application of the SPR, which I think I'll discuss kind of in longer terms here. But the other side of this is the actual execution. This is very similar to the price cap discussion earlier. I do think that some of the actual execution of this SPR release was fumbled. So in theory, let's talk about that first. So in theory, the rationale here is, because I actually agree with you that I think that national security should play a large part of this. And that's like, before I came to energy, my background was much more in the security space. I kind of came into the econ side by happenstance through energy security in funny way here. But I think of it more as if we got to the stage where this kind of really terrible scenario that you kind of depict or kind of, illustrate kind of plays out. You have a full-blown kind of energy crisis in North America on U.S. borders, onshore U.S. I don't think the SPR is going to go a huge way towards fixing it. A couple of reasons. One, the SPR you can't draw it down super, super, super quickly. Now, there's debate over exactly how quickly you can draw it down. But again, I think this latest release is illustrative. The release for this latest SPR release, 180 million barrels, peaked out at about just over kind of 1.2 million barrels a day of drawdown, which is really, really fast. Again, that's about the entire production capacity of Oman, give or take. So it's a lot of crude. I think that should be stressed. But, Russia and Saudi Arabia each produce 10 plus million barrels a day. So they were talking, a drop in the bucket if we were looking to kind of offset a sudden stop. A couple other things. You talked about kind of attacks on pipelines coming from Canada. Now, the original Keystone line, some of that does get all the way down to the south, down into the Gulf Coast, but a lot of it kind of gets dropped off along the way in the Midwest, and the vast majority of Canadian crude actually transits via the Enbridge main line into the Midwest and kind of being consumed, through the Midwest region in PADD 2. Whereas it would be very, very hard for U.S. SPR crude to make its way back up there. It's very much designed to fulfill and offset feedstock loss to Gulf Coast refineries. So I think, you could have a little bit there, but I think the other thing you had said was around refinery, attacks on refineries. And I actually think that that's probably actually the number one big concern right now, because I was saying earlier that I think this year started as an upstream crisis and very quickly evolved into a refined products crisis and a refinery bottleneck. So the other thing here is that if you did lose a U.S. refinery, two things would happen. One, we couldn't really offset it with the SPR because the SPR is crude. And if anything, that would actually hit crude demand. So you would actually need less SPR, all else equal anyways. So that said, and I think where I do agree with you is that this should be thought of as whether or not national security, or more specifically, as I'll call it, kind of national interest, which I do think is kind of a blend between both national security, kind of physical security, and this idea of kind of economic security. Because even in the case of like the 1970s crisis and the Arab OPEC embargo, the goal was to hurt U.S. consumers through the economic vector rather than, literally freeze them out of their house or whatever, right? So I think in this case, I actually think that the best way to offset that risk is actually by being proactive with the SPR rather than reactive. And I think this is where I actually think the theory of the Biden administration's release in March, when it was, this is immediately after the invasion of Ukraine. This is, again, in the context of the IEA was predicting a 3 million barrel a day loss of Russian crude, which in many ways is actually the scenario you were kind of discussing, right? A massive loss of Russian supply. That I think is actually, that's the scenario that the Biden administration initially came to this decision with. Now, where I think the administration fell short is that, as you know, as a crude trader, no narrative in the oil market lasts all that long. And I think that any effective policy framework aiming to dampen or secure, to improve the state of the oil market for the benefit of the U.S. economy and U.S. National interest needs to be more flexible. So when they agreed to it in March, I thought it was a great idea. But by June, July, after China's COVID-0 lockdowns, and after we, by that stage, saw we weren't going to lose 3 million barrels a day of Russian crude, this is that 5 million barrel a day swing I talked about. By that stage, the SPR mostly should have been wound up. I think at that stage, the release should have been done. I think you should be proactive and you should lean into it when you think it's going to be terrible. And that's back when, Brent very briefly touched almost 140. So I think that was the scenario as it started. And the rationale for why I think it should be used is people always focus on the release itself. So the supply to the market. But I think that what makes the SPR particularly valuable to the United States is not the volume of crude in the reserve itself. It's the combination of the fact that the US government is the largest effective discretionary supplier and demander of crude. Because on the flip side, after you empty the crude, you can also refill a lot of it too. So my hope would be, and where I wanted to see this policy play out, was you released it heavy into the spot market, which reduced gas prices, reduced kind of the immediate consumer impact on what, again, we were expecting was a massive loss of Russian crude. Again, in this kind of broader context of massive, 40-year plus kind of inflation highs. And what you do is you immediately, barrel for barrel, offset that sale with a purchase down the curve. And the goal would be to essentially lift at the back of the curve, or effectively flatten the overall curve. And I think this has a couple advantages. So the first is that in the very, very initial stages, when people were asking why U.S. shale wasn't growing faster, a common refrain you heard, it's less talked about now, but I think it was very common at the beginning of the year, was that it wasn't attractive. Even if crude was at 120, 130, it wasn't attractive to hedge because the curve, as you mentioned at the beginning, was so acutely backwardated that you couldn't really contract a year and a half, 2 years out at all that attractive a price. You were losing $30+ a barrel. So it wasn't super, super attractive. So that was one reason that you didn't see, or they claimed you didn't see a big pickup in that investment. I also used to work at a bank. I used to work at Scotiabank, and a lot of what I did was talking to credit committees. And bankers really do focus on, and I think everyone in the oil industry will take large issue with the idea that that when people interpret the futures curve or the forward curve as a quote market forecast of the price, it always gets groans in oil circles. But a lot of people do view it this way. And I think that's important for things like credit provision. So, you're talking about these companies can't hedge as easily. They probably can't get bank financing as easy as if the curve was flat at 120, like what we saw back in 2008. And I think the final vector here is, I think the single most important factor, variable if you were to track anything, that could eventually portend an erosion of U.S. shale producer discipline. It's not the oil price itself, but it's the share prices of those companies. A lot of the argument for why you have cash flow discipline is that investors in the space essentially got a bath for a decade plus, all of this unproductive investment, et cetera, et cetera. But if those equities, re-reached all-time highs, which at the beginning of the year, up right in through June, they were actually kind of skyrocketing higher. And then this latest round of Fed tightening really pulled risk out of the market. The oil price fell back as well, and those producers all fell back considerably. So I do think that anything you could do to help juice the equity prices also helps. And I think, again, where we were saying that the curve is not a forecast, but it's often used like that. And I think that's an important kind of thing to think about, because the other way, not just in credit, but the other way that analysts will use the curve is essentially as a way of building a discounted cash flow model for value in equity. So when you look back at the record all-time high kind of, curve back in 2008, you weren't just pricing, like an equity model just flatly using the curve wasn't just pricing in $130 spot, it was pricing in $130 flat for the next 5 years. Whereas in the latest iteration, it was 120, 130 spot, but you had massive erosion of that price over the outlook of the curve. So if you could flatten the curve, you could bring it higher, you also have a direct kind of arithmetic input into equity values. So that would be my hope. Is that you have this, it both decreases preferential options costs for the producers looking to hedge. It will also increase their relative equity values, again, all else equal. And then it will also, because, producers care about the curve, consumers just care about spot. And I think that also helps reduce spot prices. Now, that's the theory. I was saying earlier that the reason that I think the Biden administration has kind of fumbled the execution of this policy is that, one, they weren't flexible enough in kind of paring back the pace of the release once it was very, very clear that prices were already down $30 to $40 a barrel from their highs. The other thing is that they've actually made really good progress in changing the regulatory structure of how the SPR can purchase crude, allowing for future dated purchases at fixed price contracts, essentially what the futures curve is. But they didn't do it yet. They haven't actually purchased those barrels forward, and instead they have promised to rebuy if the spot price drops below the range they had was $68 to $73 WTI. Now, if I was a US oil producer, I do not blame them for not being super ready to trust the Biden administration that those repurchases will 100% take place. And even if you did trust them, it doesn't have that direct kind of arithmetic kind of loosening of financial conditions, if you will, that direct purchases down the curve would. So I think that's where you've just seen kind of sequential errors in the application of this policy. And
I don't think that it was a sincere intention. I think that your idea makes perfect sense, but I don't think the Biden administration ever had any sincere intention of that. And I think the evidence of that, Rory, is on the day that they said that, so what was the number, $68 to $72? If you looked only as far down the curve as, I think, the end of 2024, the price was already there. They could have, on the day they made that announcement, they could have bought as many long-dated futures as they wanted to at that price, at their target price, and locked in delivery at the end of 2024. And what I would say is if you were going to be actually intellectually honest about this, you wouldn't even try to refill the SPR, which would take, 300 million barrels to get back up to full from here. What you would do if you were being honest is you'd say, let's go ahead and seize this opportunity at 68 to $72 a barrel at the end of 2024. Let's go ahead and buy 500 million barrels because we know between now and 2024, we're going to have some price spikes where we're going to end up releasing some more into the front month. We're going to sell more into the front month, so we better buy ahead of time. That would be the way grown-ups would handle this. And of course, they're doing the exact opposite. They're giving lip service to the idea of buying long-dated contracts when the price gets down to 68 to 72. But the long-dated contracts are already at 68 to 72, and they're not buying them. So I don't buy any of this. I don't think they're sincere about any part of it.
I completely agree. I think that I tweeted something more or less exactly that on that day that price threshold was released. It's like, look, I think it was, October 2024 or whatever, price was already there. I think part of the challenge here is it goes back to the reason that I think there was inflexibility in the application of the SPR release earlier this year for the balance of this year. And on one hand, you can kind of say it's politics ahead of the midterms. Today is when we're recording, and that you're never going to have the White House do something that would be price positive ahead of the midterms. There's rationale to that, but I honestly, truly, to my core, believe that the larger factor that explains their inability, or at least apparent unwillingness, to wind back the releases was this was already a massive change in pace for DOE, for the team underpinning the release of the SPR. This was already a massive undertaking, something that had never happened in the history of the SPR, something of the scale. That was already such a gigantic change of pace that I honestly just don't think the bureaucracy of the government is able to be responsive enough to the change in those conditions, because you would have needed, months of meetings in order to change the policy. And by that time, you could have actually needed it again. In this case, there's actually an argument that basically I think that the SPR release should have stopped probably in July. That would have been when I would have stopped it myself, if I had, oil czar policies. And there's actually an argument that depending on, we could both be wrong, and maybe you actually do get more loss of Russian supply from the December 5th threshold. There's actually an argument, mix that with a China reopening. You could actually need the SPR right then. So that's I think the challenge is you never exactly know when you're going to need it, in which way you're going to need it. So I think you need to build in structurally more flexibility to the SPR governance, which unfortunately just doesn't seem like it's going to be the outing. I think the biggest weakness of the SPR is the fact that it's run by politically exposed constituencies. I think that's versus something like the Federal Reserve, which has a history and a kind of at least an air of independence here. The SPR does not have that. I think an idealized policy would have a completely independent professional management of the SPR as an asset with, congressionally defined targets that, let's say, the way I had mused about it earlier was, when backwardation hits the 95th and above percentile through a distribution, then you release full. And in any moment where you have exceptionally, in an exceptionally backwardated market, like you saw at the bottom in 2020, you should be buying every single barrel you can possibly get your hands on. That, unfortunately, is not the world we live in right now. But I think that would be my idealized way to realize this policy. And so I think on some level, we kind of agree and disagree on the kind of stated purpose and an idealized mechanism. But I think the challenge mostly comes down to the execution of it. And that is where, at least thus far, that has, left me wanting more from the administration.
Final point on the SPR, because I think it's a very important one. When we talk about refilling it, I think that crude quality matters, and unfortunately, this leads us to a real political football, which is, if I was in charge, I would say, look, not only do we need to fill the SPR to the brim at any cost, but we need to fill it with heavy blend stock, because all of the shale oil that is produced in the United States, if we ever got into a war situation where we really did have a national security threat, you run into this problem that the refineries in the United States cannot refine that into the middle distillates, the diesel fuel and the jet fuel that would be most needed. You can make a fair amount of gasoline out of that light oil, but in order to make the kind of fuel that you need, which is diesel fuel and home heating oil and jet fuel and the other middle distillates, you have to blend it with heavy blend stock, which we don't really produce in the U.S. Now, some of it comes from Canada, but most of it comes from places like Iran and Iraq. So, I can't imagine it being even plausibly politically correct to say, okay, we're going to refill the SPR now and we're going to do it all with, Iranian oil that's imported and not with American oil. That would never sell politically. But if you refilled it with American oil, which I think is the only politically viable way they're going to pull this off, it seems to me it creates this huge risk that now the SPR is full of the same kind of super light oil that can't be refined without blend stock. And you suddenly have this major, and you know much more about the physical market than I do, but it seems to me, just as a trader, like it creates a major vulnerability that we would have a bunch of oil in the SPR, but it has the same non-refinable characteristics of the shale oil that we can produce. How could we get the SPR refilled with heavy blend stock without going to Iran and Iraq and Venezuela?
I think you're right there. I don't see it being, in my idealized policy, I'd probably see much of the SPR being refilled with a type of oil that's been emptied, which has been largely, some of it's been light, but some of it's kind of, the largest portion of it was this medium sour crude. And I actually think, and which is kind of more or less exactly what the US average, kind of an API of, I think it's like 31 to 32 and a little bit of sulfur. That would be the ideal barrel. This would be kind of what you'd theoretically want to blend towards, as you were saying. The challenge is, it's been explained to me by people much smarter in this area than me on the petroleum reservoir side, is that it probably isn't viable to fill the SPR with, say, Canadian crude, because it would likely separate in the actual reserve wells. But I do think that I think ideally you would fill it with kind of this medium sour stuff, which I was talking about earlier, but Guyana is actually producing some, brand new medium sour crude that, right off of the coast of where the SPR would be filling. So I think that's a great place to look. But I think the other thing here is that, at least on my, the crude market's a global market. Oil prices are global. I think you saw political hay made of the fact that a lot of this SPR release was in fact exported. It wasn't even refined in the United States. But I think that's fine. I think that the asset here for me, and I was saying this earlier, isn't necessarily the crude itself, but it's the capacity to be that discretionary buyer and seller. And I think that in this future market, you could still work with that even if you did fill it up with US, light tight oil, although I would agree that it certainly is not ideal and feels like a very bad kind of portfolio diversification strategy. But yeah, I would probably ideally see it refilled with kind of medium sour crudes, which is kind of what's largely in there right now, kind of like what you see in the Mars field in the US Gulf Coast.
Is there enough production? And from a political standpoint, it seems to me like it would be very hard, first of all, to get the American public to understand this crude quality matters issue. I don't think the politicians understand it themselves. How could you say, well, look, we're not going to get any oil from the state that you, Mr. Senator, are from. We're only going to get it from this one field that's producing this heavy stuff that we say we need for blend stock, which is kind of a technical issue that most people don't understand. I don't think that's politically viable. So I think that we're going to end up with refilling the SPR with super light oil that can't be refined. Am I missing anything?
No, I think you're probably right. And I think that goes back to kind of my point around like an idealized utilization of the SPR in kind of my kind of perfect theoretical world would be far more independent of those kind of political pressures. Unfortunately, I think you are right. And I think you will likely see some, at least, lip service towards refilling it with, American produced oil. But hopefully, I think, as to where you could potentially get that, again, there are fields off the offshore Gulf of Mexico that do produce these these medium sour crudes, and I think that would hopefully be the best way to kind of get both to kill both birds with this one stone here of kind of pleasing a political constituency domestically while still to your, I think, very correct point, kind of getting crude in there that is not completely sideways to what expected need would likely be.
Well, Rory, I can't thank you enough for a terrific interview. We didn't even get to weaponization of oil, which I think could be coming sometime, but we're way over time, so I guess we'll have to get you back in a few weeks for another update. Before I let you go, though, please tell our listeners about commoditycontext.com, because you've got an incredible amount of free content there. Please tell us what your services are, what you do, what's for free, what's not for free, what can we expect to find there?
Yeah, so commoditycontext.com is where I'm publishing all of my research now. I started publishing last June, so June of 2021. For the first year or so of publishing, everything was free. There's now a paywall, although even people that are still receiving on the free email list receive, summary bullets and what I like to call my banger chart, the best chart from the post. I'll be releasing shortly on Guyanese offshore oil production. I also have a couple different monthlies. I have a global oil monthly and a North American oil monthly, both of which cover kind of a growing portfolio of analytics and data I've pulled together, models I've cleaned, et cetera, that are updated and kind of presented graphically. I'm a big chart guy. So that comes out every month. And then also on top of my kind of thematic pieces, which are, this Guyana piece or stuff I've done on the SPR and these monthly kind of periodicals, I also have a weekly piece called Oil Context Weekly, which is essentially my wrap up of what I like to think the major kind of data releases, narrative shifts. Last week was a lot about COVID-0 as an example. And also things that I think are near and dear to your heart, Eric, like term structure, the shape a curve, where your calendar spreads and your crack spreads are going. So kind of a bit of wrap up that, and that's just to kind of provide a bit more of a constant heartbeat of the market on top of these deeper thematic dives I do.
Well, crack spreads, weaponization of oil, and a whole bunch of other topics I'm sure we could fill another hour with, but we'll have to save it for another interview. Patrick Serezna, Nick Galarnik, and I will be back as MacroVoices continues right after this. After being completely sold out of advertising space for the last couple of years, we finally have capacity to add a new advertiser. MacroVoices has a PodTrack-certified global audience of over 170,000 listeners, and each weekly episode typically gets 60,000 to 80,000 downloads. We have more than 20,000 accredited investors who have registered with us as accredited, and we estimate the total accredited investor audience as at least 40,000 accredited listeners, which we believe to be the highest number of accredited investor listeners of any podcast on the internet. We strive to accept tasteful advertising from advertisers whose product is likely to appeal to our audience. So we're looking for another investment or financial services advertiser to fill the space I'm speaking in right now. If your company wants to advertise on MacroVoices, please email sponsorship@macrovoices.com for more information. Now let's get right back to the show.
Now, back to your hosts, Eric Townsend and Patrick Serezna.
Eric, it was great to have an extended interview with Rory Johnston. Now, joining us here in the post-game segment is Nick Galarnik. Now, Eric, at the beginning of the show, you said you had a few more comments on where the oil markets might be heading next, but you wanted to save until after the feature interview with Rory. What's on your mind?
Well, Patrick, China reopening is the big catalyst, as I've said many times before. Let's face it, despite the physical market still being quite tight, as evidenced by steep backwardation at the front of the curve, the fact remains that recession fears have outweighed supply concerns, and the market is still down more than 30% off of its high. China's full reopening, I'm convinced, will be the catalyst for a major trend reversal. And I still think that China reopening is most likely in the works, despite Bloomberg's recent reporting to the contrary. Now let's just go over the history of this. It all started with a rumor, or more likely an intentional leak, that a committee had been formed to plan the reopening, headed by a very well-connected member of the Chinese Communist Party. I think that was still solid intel. They're planning the reopening. It's not planned yet. They've just pulled the committee together. And per a new Goldman Sachs research note, it appears that China may already be restocking its own SPR in anticipation of that reopening. But nobody seems to be paying attention to that in the market right now. Over the weekend, Bloomberg reported that reopening hopes had been dashed when China said that it was still committed to its zero COVID policy. English speakers who read the Bloomberg piece panic dumped crude oil futures into the Sunday open, resulting in a massive gap down open on Sunday evening. But then crude rallied later on Sunday evening to new higher highs as soon as Asia opened, almost as if people who understood what she said in Mandarin interpreted the news rather differently than what English speakers read on Bloomberg. I think Bloomberg badly misinterpreted China reiterating its, quote, commitment to COVID zero policies. Bloomberg seems to have interpreted that to mean that the reopening was not being planned after all. I don't think that interpretation makes any sense. But what Bloomberg interprets in the news from Asia is what Western traders tend to go by. As far as I can tell, committed to zero COVID is entirely consistent with still planning the reopening. But it also means that they're probably not in as much of a rush as a lot of people thought they were. So what did Bloomberg expect them to say? To admit that their COVID zero policies were dumb to start with and have been a colossal failure? Obviously, they would never say that. When they're ready to announce their reopening plans, I expect them to say that zero COVID has been a terrific success. And now, in the next phase of zero COVID, they'll be reopening the economy in a manner consistent with zero COVID, which they will never admit was ill-conceived from the start, which frankly it was. So for the moment, the market still seems to think that the reopening intel has been disproven. I rather strongly disagree, but that plus news of more regional outbreaks in Guangzhou and elsewhere in China have put a bearish tone on the market, at least until the CPI data came out this morning. I don't think that the outbreaks matter as much as most people think, because China knows perfectly well that this policy doesn't make sense. There must be some reason behind the scenes for why they've continued it, and when they're ready, they'll reopen the economy and they'll find a way to announce it to say that their COVID zero policies have been successful. The bullish trend line, as well as most moving averages, have now been violated to the downside. So there's plenty of room that the market could continue lower to test $80 or even $75 on WTI if the mood doesn't change. Now, we're just recording a few minutes after Thursday morning's CPI print, which appears to have reversed the direction of the market back to the upside, at least for now. But the real test will be where the market closes on Thursday afternoon. We would need to see a close on WTI above 88.50 and preferably above 89.25 to say that the downtrend is over and we've actually seen a trend reversal. And frankly, even after the CPI print, numbers are already quite a ways south of that and look like they're headed still further south as I'm speaking. We're seeing a retracement of the big spike up after the CPI print. One way or another, I still think that a new bull trend will emerge as soon as the China COVID outbreak news gives way to more signs of an actual reopening in China. However, I do see a pothole in the road ahead for the bulls. Leading up to the December 5th imposition of sanctions in Europe is definitely going to be bullish as everyone assumes that 1.5 million barrels is coming off the market. That bullishness should last beyond December 5th until data becomes clear as to what's actually happening and how much either has or hasn't come off the market. But I think that then maybe there's room to realize, oops, maybe nothing is actually coming off the market. Or more likely, there will be some oil coming off the market temporarily, but I don't think it's going to take too long before Russia figures out a way to overcome the logistic nightmares caused by these sanctions and figures out how to sell its oil to somebody else. EU energy prices will definitely go up as a result of the sanctions, but China's cost to import Russian crude will likely go down. So to my thinking, the only reason to expect barrels to be taken off the market would be temporarily until they sort out the alternate delivery logistics, which could take a few months. But eventually, I think Russia will have no trouble finding a buyer for its oil, and that oil will come back on the market. That could be a little bit of a bearish interruption into my otherwise bullish forecast. But again, that bullish forecast isn't activated until we get some solid indications of China reopening. And right now, all we've got is rumors, and those are rumors that for the moment are being deeply discounted by most market participants. Overall, there's lots of moving parts here, and plenty could happen to change the outlook. So stay tuned to MacroVoices for more updates.
Now let's get to the charts. Now, listeners, you'll find the download link for the Postgame chart deck in the Research Roundup email. And if you don't have the Research Roundup email, it means that you're not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Rory's picture that says looking for the downloads. Nick, let's get to talking some of these charts. I know you've been watching this S&P in the reactions in this post-inflation number. What levels are you watching here?
Yeah, that was quite a move, Patrick. We saw inflation come in lower than expected, and the S&P, as I speak, is up about 4%. Tech is up about 4% as well. So looking at the November 11th spot OPEX for tomorrow, the spot right now is 38.60 on SPX. Expected move for tomorrow is about 60 points in either direction. So it's about a 1.5% move either way. Upside would be around 39.20, downside around 3,800 or so, which is right where support would be now, as that was previous resistance, right? So given that we've broken above this level, if we keep on running the upside today and we see a break of 3,900 or so, we should see a push toward 4,000, which is a key level of resistance. So the bulls may be in control right now. We got to wait and see what happens today. But that's my thinking on the markets for today on SPX. Now, Eric, what are your thoughts post-inflation here?
My only strong conviction is medium to long term, in the sense that I don't think the final bottom is in, and I still think there's plenty of bad news to come for both markets and the global economy. But from now to end of year, I really have no idea. There was what seemed to be a good setup for a rally into year end that seemed to have fizzled after the last FOMC. The news could flip it again back to the upside, so I really don't have any strong conviction. This morning's CPI print definitely spiked the market higher, but it remains to be seen whether that upside momentum holds through this afternoon's close. So my view is I have really, frankly, no idea what comes next, but I strongly doubt that the final bottom is anywhere close to being in for the stock market.
Well, Eric, in principle, I agree with you. It's just not enough evidence to know that we're not out of a bear market. But one of the things that I've been looking for is, if there was just any scenario that was alleviating the stress on the market, whether inflation coming in lower, one of the arms of the government flipping Republican, all these kind of things would give a short-term tailwind to this market. With today's uptick in the post-inflation number, I'm actually thinking we clear that October high. I feel that in the coming weeks, there's a legitimate chance we're going to see the 4,000 level, which is a fib level that we're watching closely. And under the right circumstances, maybe even a rally into the holidays where we could be even going back to August highs is all possible. Now, even though I may have a slightly short-term bullish view, I still think that 2023 is going to have some serious obstacles that leave more bearish downside risks. But you know what? Right now, technically, we can only trade what's the most immediate short-term trend. And I feel that generally the S&P 500 edging higher, particularly if it has the gusto to beat 4,000 on the upside, could really neutralize the sell cycle we've been in for most of the year and allow things to be stable at least into the year end. Nonetheless, I wanted to move on to page 3 where we have the chart on the VIX. And Nick, I wanted to talk to you about this because I'm actually a little bit surprised. We were going into elections. We were going into this inflation number, which is considered pretty important. And yet the VIX kept crawling lower under 25 for a little while. Here we are sitting still around this area, but I thought at least that we were going to see some higher volatility in anticipation of these numbers. Now that it's got a bullish tilt, we could certainly see some, further vol contraction. But what are you thinking here in terms of the levels on volatility?
Yeah, it was very surprising looking at the VIX and watching it move post-election. But my thinking is that we haven't seen it spike because we haven't seen the outcome of the election yet, right? It's too close to call right now, and it may be that way for the next month or so. As I speak, spot VIX is 23.72 roughly, and that denotes about 1.5% moves each day. Now, the funny thing is last week I mentioned the expected move to the upside and downside on SPX, which is the VIX is predicated upon. They're out of the money options. And yesterday we were almost at the same point we were at last week. So we basically didn't move for an entire week on SPX. Now we've moved higher a bit, and obviously the VIX is down today, about 10% already as I speak. But I do expect it to pick up, and support is heavy at VIX 20 roughly, right? So looking at the chart for the year, the support is very heavy at around VIX 20. But again, if we see a move to 4,000 on SPX and above, the VIX should die down toward that level, at which point I may go long VIX. Now, moving on to the US dollar on page 4, Eric, has anything changed in your thinking?
Until this week, to my eye, the chart was showing a sideways consolidation in the range between 110 and 114 on the dollar index. Now it's starting to look like a new gently downsloping price channel is forming, but it's still early to make that call decisively. So my outlook is flat to lower in the short term, but news events could easily force a change of direction.
Now, Eric, those two levels are certainly important. For me, though, I look at the bigger intermarket significance of the dollar index. The dollar rising throughout the majority of the year has been a huge pain on almost all risk assets, and it's been dragging everything lower. And one of the biggest questions to continue to ask is, have we seen an intermediate high of the dollar? And I don't want to say major high or a major reversal and it's all downside for the dollar. But if we just see the dollar stop rising, and even if we see mean reversion back towards even a midpoint where, like during the summer, we traded down around 105 to 108, if we suddenly seen the dollar just backing off, not crashing or anything, just backing off, it may be the tailwind that risk assets need, and particularly a number of these commodities that we're going to be talking about. But that could also be that tailwind for the stock market that could see things, levitate higher into the year end. One way or another, the first reaction has been the dollar weakening, and this is certainly going to be very important for all the different risk assets we're looking at from here.
Now, Patrick, on page 5, we have the crude oil chart. What levels are you watching here?
Okay, so let's talk crude. And one of the things for me here, obviously, Eric, is you've been sharing with us all of the different things that you're observing on it. But for me, I want to see a simple pattern emerge technically, the pattern of accumulation, pattern of higher highs and higher lows. And when dips like the ones that happened over the last 48 hours occur, that we want to see buy on dip behavior immediately emerge and take advantage of the short-term buying opportunities. Clearly, there's a substantial overhead resistance along the 90 to 95 zone where all the highs of the second half of the year have all been. And it would certainly be quite technically significant if we broke out above that. But right now, the most important thing to watch for the remainder of this week and going into early next week is, will the bulls be able to reverse the selling of the last 48 hours? If they do, and we get back up in the 90s, that would, again, continue to demonstrate that characteristic of accumulation, and something that I think that is going to be really interesting. Now, what I really, though, wanted to do was move on to gold. Now, Eric, what are you making of the recent strength that we've seen in this breakout?
First, the bear trend line that's been in place since the March peak has finally been decisively violated to the upside. So from a trend line perspective, we already have an upside breakout. Next, from a moving average perspective, the 55-day moving average has pretty much contained this market since March, with only small and short-lived excursions above the 55 at the interim peaks along the decline. Now we have a very decisive break above the 55-day in the last 3 sessions, but we need to see that sustained for a few more days before it's completely conclusive. The next hurdle to overcome from a moving average perspective would be the 100-day moving average at 1723, and this morning's CPI print just broke the market above that level. Finally, in terms of lower highs and lower lows, we need to see a daily close above 1735, which would be above both the September and October peaks, to confirm the pattern of lower highs has been broken. As we're recording just after the CPI data came out on Thursday morning, we just hit 1735. But the real test is going to be whether we can hold above that level through the close and then stay there. But it's essential to understand what I think is driving this sudden strength in gold and what could cause this newfound optimism to evaporate if the monetary policy outlook changes. I'm convinced that the reason for all of this sudden strength is pessimism about the economy is growing, and the view has become that hawkish monetary policy is going to break something, probably sooner than later. Inflation, on the other hand, doesn't appear to be going away, although this morning's CPI print is a little bit of a miss compared to expectations. If it turns out that even after hawkish monetary policy breaks something, that the Fed still stays the course on rate hikes until inflation measurably comes under control, then this bullish optimism for gold may prove to be not wrong, but perhaps just a little bit early. Now, to be clear, eventually the Fed will break enough things that they'll be forced to reverse course on hawkish monetary policy. Inflation still won't go away, and the expectation of rapidly falling real yields will be realized, and that's definitely uber bullish for gold. I'm just not convinced that this outcome is as close at hand as the market suddenly seems to think.
Yeah, Eric, I'm looking at gold a little bit more optimistically. I've really looked at it as a cross-currency to that US dollar, and what the US dollar does next was going to be a really important part of whether or not gold was going to have some short-term year-end rally. I was looking for a fourth quarter rally. This is certainly a healthy start to it. What it really would solidify this breakout would be a legitimate break above the October high, get it north of 1750, and then see that pattern of higher highs and higher lows as old dips start being bought. If we see that, that will certainly pop gold up on everybody's radar and maybe allow it to have a strong finish for the end of the year. Obviously, we're only a few days into a rally. It's a very premature to be getting excited, but it'll be really, it's something to watch to really see whether or not the bulls can build on this.
Now on the next page, you have a chart on copper. What are you thinking over here, Patrick?
Well, it wasn't just gold and silver that moved. We saw a whole series of these industrial metals. Arguably, you can see everything from iron ore to the different coal plays, and all these different basic material industrial metals are all also moving. Obviously, thematically, it involves that kind of idea or speculation that inevitably China is going to be reopening at some point, and there's traders that may be wanting to front run that, but also the fact that the dollar is weakening is finally alleviating the pressure on these commodities. Copper definitively put in a basing formation over the last 6 months, and so now that we're seeing it attempt to break above the August high, maybe a lot of these different types of commodity plays may actually start to bull run. It may not just be gold, but it might be an entire commodity complex rally, and that's certainly something I think could potentially happen here.
On the last page, we have a chart of the 10-year yields. What are your thoughts on these, Patrick?
You know, interest rates here is really important because not only it was a deadly combination of a strong dollar and much higher interest rates that basically forced a complete repricing of risk assets. And so if we now see the reverse, where we see obviously the weak dollar and subsequently lower yields and interest rates start to in any way back off as bonds rally from incredibly oversold conditions, this could be an environment that continues to also add further fuel to a potential year-end rally. Again, I don't want to get uber bullish on bonds. I don't want to get uber bullish on stocks, but let's put it into context. We've gone through a 9-month shit show, and the markets were an awful place to be in almost every asset class. And inevitably, every trend has a counter trend period. And things being so oversold as they are, us going through a 1 to 3 month counter trend rally would not be uncharacteristic of in this kind of oversold condition. And so with the yields now backing off, off as inflation has come in at least in line to slightly cooler. That may allow all of the bonds to rally a bit, yields to come off. It'll be really interesting to see if it stays below 4% here and whether that sends it down to 3.5 to 3.75. It's certainly something to watch.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are in the last pages of the slide deck, or just go to bigpicturetrading.com. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find a transcript for today's interview, as well as a link to the chart book we just discussed in the postgame. There's also a link to a number of articles that we found interesting. So you'll find this and so much more in this week's Research Roundup.
So that does it for this week's episode. We appreciate all the feedback and support we get from you, our listeners, and are always looking for suggestions on how we can make this show even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases, and follow Patrick at Patrick Ceresna. On behalf of Eric Townsend, Patrick Ceresna, and myself, thank you for listening, and see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.